Right, how to grow your wealth like the rich. Guys, welcome to my channel. My name's Mark. I'm an entrepreneur and property investor. I've got about £3 million worth of property. I've got index funds, probably in six figures, and I also own a business that turns over many millions. And in today's video, what I wanted to do was just give you some insight on how people grow their wealth. And I'm not just going to be drawing from my own experience. I'm very, very fortunate to know lots of people who are millionaires, multimillionaires, decamillionaires, and even people who've got hundreds of millions in net worth. And all these people tend to have the same things in common. And what I'm going to do in this video is really break it down so that you can understand, first of all, how they got to where they got to, and then what they did with their money in order to grow that wealth over time. Because I'll be honest, it seems very, very ubiquitous when you speak to these guys of what they've done. So guys, if you haven't already given this video a like, please give it a big like. We don't do any upsell on this channel. It massively helps me out with the algorithm. It's the only thing that I ask for. So if you give the video a big like, it really does help me out. And if you haven't already subscribed, why not consider subscribing? Because there's no upsell, because there's no course, I can give you all the information without holding anything back, and hopefully that will allow you guys to make better financial decisions. Let's get into the video. Let's start talking about how people grow their wealth and become rich over time. Now, the first thing on my list, and as I said, this video is probably going to go into a lot of detail, so it looks a bit bare at the moment, but we'll start to work it all out, and we'll start to put some figures in, we'll put some graphs in, and we'll start to understand how this all operates together. Now, the first way and the most traditional way that I think that people become wealthy is businesses that people build up over a period of time. And I think really these have to have three things in common. And this, I would say, is generally across everybody that I know that has become wealthy, these are the three things. First of all, they own it. So they're either a shareholder, a majority shareholder, a sole shareholder, but I'm thinking about people that I know that built big tech companies. They owned a significant proportion of that business. I'm also thinking about people I know who own small businesses that become worth millions. They own the whole of it. So ownership is really key. So they own it. So the second thing that I want to put on here is that they operate the business. That means that they're involved in the strategic thinking, they're involved in the management, the running, maybe the day-to-day operations. Whatever it is, they generally, when they're building this business, they operate it. Now, if they don't operate it or anything like that, it's generally going to come under number three, which for me is index funds or stock market. It's going to be more of just a pure investment. Whereas owned, operated businesses are things that people are actively growing. And the third thing that I think is really important on here is they understand it. And whenever they're making an investment like this, myself included, I want to own it, I want to be involved in the operations, but I also want to fully understand what the outcome is. Now, you can imagine that myself and lots of people get pitched all manner of opportunities all the time. But I personally, I listen to Warren Buffett, I listen to Charlie Munger, I listen to people who really say, you've got to understand what it is that you're investing in. And for me, understanding how it's going to be monetized, how we're going to exit, what the role of the business is really, really important. So I think if you're going down the route of having a business, these are the three things you really want to follow. You've got to own it, operate it, and fully understand it. And if you do those things, that is likely to lead to more success rate. Now, the second thing on my list is property. And most people I know that are wealthy own property in some guise. Now, it might be that they own HMOs. So that's house of multiple occupancies, single lets. It might also be apartment blocks. It could also be hotels. But whatever it is, it's likely that they view it in two ways, the same as I do. Number one, the asset, the bit that you own. For me, I've got £3 million worth of property. Number two is the business within that asset. So a hotel will have a business within it. The HMO will have a business within it. Single lets, a business within it. All of these things will have a business attached to the investment, if you like. And they will give you a return. So I didn't really talk about returns with business, really, because that is infinite, right? Like, there is no way for us to know what sort of return you can generate with business over time. Now, with property, it's pretty simple. With rents, we know we're going to get from 8 to 12%. With HMOs, 15%, but carrying more risk. With hotels, maybe even more, maybe 20%, 25%. Something like that I've heard thrown around to me, like 20% return on investment for a hotel is what people are looking for. Again, carrying more risk than a HMO, more management, more difficulty. Single let, probably the easiest type of property you can possibly do. So they all carry different amounts of risk and give different levels of return, but this is cash on cash. There's also the property appreciation, right? So for example, for me, July 2021, we valued my portfolio at about £3 million. And since then, we've been using the Halifax House Price Index to track as that property price has gone up or down month on month. So far to date, up until March 2022, the date I'm recording this video, I'm up 203,000 if my portfolio has averaged the average return, which is about 8%. But of course, I don't have £3 million in there. That is leverage. I actually have mortgages on these properties. So I probably only have £1 million in. And that's an additional sort of 20% on capital deployed over that 9-month period. And as you can see, because you get paid twice with property, you get paid once with the ROI, with the rents, with the bookings, with the whatever it might be, the business within the property, and twice with the capital appreciation. You can see why most wealthy people own property in some form. And I think it's really important to also say it's a good hedge against inflation. So as inflation increases and the price of maybe building a new property increases over time, it is likely or highly likely that the value of the properties are going to increase over time. So it's a good hedge against inflation because it's likely that the asset, the raw asset, is going to become more valuable over time, or at least it has always, over a long enough period of time, it has always become worth more. And I'm not a future teller, I can't tell you what's going to happen in the next 5, 10, 15, 20 years. But if you took a generational view, I would say it's highly, highly, highly likely that it's going to become worth more. And certainly for me, over the last 12 months, I've added about 200,000 to my net worth based on the fact that the property prices have gone up. And remember, I earn all that appreciation. The bank doesn't earn any of it, but I do owe all the debt. So if the prices come down, this is where the risk comes in. I still owe the same, and that is really the risk and reward, and you've got to understand both sides when you're playing the property game. Now, I know quite a few people who've got largest portfolios, and they tend to change the leverage as they become older. So I know a chap in his 40s who's got about 25 million of property, something like that, and he's currently leveraged at 65%. And he said that he's going to reduce that to about 50% by the time he is 50. And that is just because his attitude to risk is reducing over that period of time. And he doesn't really need to build his portfolio anymore. He's got £20 million worth. It brings him in £20,000 to £30,000 of net income per month, plus the capital appreciation. He feels that he wants to start reducing his risk. I also know a chap who's got about 15 million, and he's currently at 75%. And he's in his 50s, and he's looking to continue to grow his portfolio. So I think this is an incredibly individual thing in terms of what leverage you're going to use, but property as a leveraged asset can generate fantastic returns, especially in a low interest environment. Now, if interest rates got to 10% and you're only getting 10% on your cash on cash yield, you've now got no yield. So you're going to have to reevaluate how much you would be wanting to borrow. Prices are going to change, rents are going to change. There's a lot of things that are going to change over that period. So we just need to be mindful that property is going to carry more risk, generally speaking, be more effort because you've got tenants and you've got mortgages, solicitors, all that sort of stuff, so it's more effort, but potentially also more returns. And certainly property has been, for me, a big driver of wealth. You know, I can remember buying my first house for 175,000. Today that same house worth about 425. It was the reason I was able to afford the second house. It was the reason I was able to afford the third house. It's probably the reason that I was able to afford quite a few of my properties. I think without that first property, without remortgaging remortgaging it, I would be far behind where I am now. So property for me and business have both been really good generators of wealth. Now, the last one on here is index funds. And I think what I've done on this, subconsciously, without intentionally doing it, is kind of described my journey. Because I started off with an owned, operated, understood business, and I still run that to this day, and that turns over many millions and hopefully will make me millions to come. We've had a tough time during COVID, but ultimately we're on the right track now. I've funneled the money that I've made from there, and I've bought property, and then from that I've generated more wealth. And now, as I'm looking to potentially try and de-risk and make sure I've got a little bit more of what I would call liquidable assets, so index funds, for example, you can liquidate tomorrow, I'm moving more into index funds as well. So I'm still buying property. It's not that I'm not buying property. I'm aiming to buy 1 or 2 a year, about £500,000 worth this year. Our first purchase should be completing shortly for 2022, and then I'm hoping to find something else. But index funds, you know, I'm also looking to make sure we maximise. Now, I'm in the UK, we have something known as an ISA, which is an individual savings allowance. That allows you to invest £20,000 a year, so £40,000 for me and my wife per year, into index funds in a tax-free wrapper, which means any money that earns over the lifetime of the investment is tax-free. And that obviously makes it a very, very attractive investment for me. It also means that you can do it with a very small amount of money. I mean, you can invest as little as £25 a month. Now, I'm not suggesting you should. I think £25 a month isn't going to get you anywhere very quickly. I would rather you, if I was advising somebody, I would say, look, £25 a month is nothing. You might as well spend that money on trying to get some more information, or trying to maybe build a business or something that's going to generate more income, because you need a much larger amount of investment than £25 a month to really generate anything significant over a lifetime. But myself and my wife, we do £40,000 a year. We've got 6 figures in our index funds. I'm hoping to get that up to 7 figures in the next 6 or 7 years. It will take us a reasonable amount of time to get it to $1 million, but we're going to continue doing that. And we base our investments around 3 real main funds, which are the Vanguard, and the 3 funds that we use a lot of, and they're all ETFs, and we use ETFs, which is exchange traded funds, because the fees are extremely low, and we use index funds because, again, the fees are low, so we're controlling what we can control. We can't control the market, but we can control the fees we pay, and we use the all-world high income, and that dividends out about 3.5%, I think it is at the moment. We use the FTSE 100. Again, we're UK based, so we like supporting our UK businesses as well, and that's dividending out about 3.9%. We have some emerging markets, and that dividends out about 2.8%, something like that. So our dividend yield is on average about 3.25%, something like that. And we're far more geared towards the all world. So we're far more geared towards global. We've got a little bit in FTSE, a little bit in emerging markets, and I'd be lying if I didn't say we had a plethora of other index funds that we invest in, but much smaller amounts. These are the 3 main ones that we put a large amount in. And we have the all world high income, and we also have the all world, just all world. And that really means that we can have the technology side, the growth stocks, as well as the dividend stocks. So for us, that's how we invest in index funds. And again, when I speak to people who are wealthy and people who are maybe building their wealth from this platform, they tend to do the same sort of thing. They invest as much as they possibly can into here. They've made a lot in property, they've started or owned a business, and if they haven't started or owned a business, maybe they're a partner in a law firm, they've worked their way up, I met somebody who was an actor, and again, for him, his business was his acting. He then moved that money into property and was just starting on index funds. It's really funny how that sort of journey seems to be, unique skill, earn the money, invest in property, invest in index funds, and it seems to be the route that people like to take. So guys, I hope that this has been useful information. My experience leads me to believe that these are the 3 classes of investments that you need to understand. So businesses that you own, operate and understand, property, HMOs, single lets. What was AB? Apartment blocks, hotels, and again, with this, HMOs, anything with more complexity is going to give it a little bit more of a potential return, but carry more risk. And then index funds, which ultimately are the easiest thing in the world to do, but carry a lesser return in terms of dividends and growth. In terms of what you can expect in your growth, probably about 9% per year with dividends invested. That's approximately the average long term. So guys, hopefully this helps you. Give this video a big like if you haven't already. Subscribe if you want to. Thank you so much for watching, and I will see you on the next video. Cheers, guys.